Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is Dr. Jim Willie, editor of the Hat-Trick Letter, found on GoldenJackass.com. Jim, thank you so much for joining us today.
Oh, it's a pleasure to be back, Elijah. Again, a lot happening. It's a little scary, you know? I don't get frightened easily, but when I see the whole financial system and economic system going down, I wonder, well, gee, what are people going to do when their businesses fail in a wide sweep? I'm not talking about, Central American businesses failing. I'm talking about the major industrialized nations. So we're getting a lot of things happening at the same time. I just don't see the acceleration like it was a month ago.
Right, and speaking about these major industrialized nations, you recently wrote in an article that the industrial so-called developed world, through their central banks, are currently monetizing over 100% of their global sovereign debt insurance. Now, this is the first time this has ever happened. Did you want to explain what this means and the importance of this?
Yes. To begin with, many not so experienced listeners might say, well, how is that even possible? What do you mean they're monetizing over 100% of the debt? How could you do more than 100? Well, easy. You have maturing debt. So the debt from 2 years ago that was on a 2-year time frame, 5 years ago on a 5-year time frame, that has to be rolled over. So you either find new investors or you monetize it. By the way, monetize means print money, then buy the bond, which is what third world nations do. So what you're seeing is the entire industrialized nations have become third world. Now there was a graphic that I provided in a public article and for my Hat-Trick Letter, and the graphic was of 4 major nations. I think it was United States, Japan, Europe, and Britain, considering Europe one nation, the European Union. So those 4 nations actually had a certain amount of debt, and it was all covered by printed money. So does anybody understand out there that when you print money to cover debts, it's not a good thing? I don't care that they call it stimulus. All it does is stimulates the Wall Street investors and owners because they've got toxic bonds that they can get rid of. Since when is that stimulus to the economy? It's the exact opposite. What it means is that you have a generation of outsourcing to exploit cheaper labor in emerging markets. And now you finally have that outsourcing causing a problem with inadequate industry within, say, the United States, Europe, and Britain, and Japan. And that's not really true of Japan. They've got different problems. They're always a different situation in Japan. But, U.S. and Western Europe, focus on them, considering Britain, part of Western Europe, they've gone too far in outsourcing. You can't send your industry to Asia and India and other other emerging market nations. You can't do that and expect, no problems back at home. The United States under Greenspan was saying, well, it's not a really big deal because the financial sector is robust in the United States. Well, gee, how'd that turn out in 06, 07, and 08 with the subprime bond for mortgages collapsing and the housing market going down with it? I mean, you can't do these things. So it's a guarantee of systemic failure since it's not stimulus. This is a toxic backfire. It's a last gasp in a horrendously insolvent situation. What it means is that 2 things. There's inadequate savings by the rest of the world to cover, say, the U.S. debt, or they don't think it's a safe place to invest in these sovereign bonds. If I were a private investor and I were looking at a place to invest, first of all, I would say the treasury bonds don't offer any bond yield for interest. And second of all, I don't want to invest in something when the Federal Reserve is monetizing it and probably lying through their teeth, monetizing a whole lot more. And third of all, further study would indicate that I wouldn't want to invest in something where you have all these hidden contraptions with the derivatives, like the interest rate derivative, interest rate swap derivative that takes in free money from the low end, the 0% interest rate on the short end, and uses that free money to create artificial demand on the long end, meaning the 10 and 30-year bonds. So the demand is artificial. The central banks are in there covering the debt. The investors have gone home. And this is not a market anymore. But this is typical. The stock market is the same way. They don't have much in the way of profit. You have cutbacks. You have companies not investing in their businesses. They're investing in their own stock. You had Hewlett Packard announce just last week that they want to increase their stock purchase program and cut back on investing in the company. I mean, you don't have markets anymore. The currency markets are a joke. The bond markets are a joke. The stock markets are a joke. The Western financial market systems are a joke. That's why we're going to the gold standard. It is the solution.
Those are some very interesting insights. Now, on the topic of the U.S. bond market, in your recent article, you said that small U.S. bond trades can now move the U.S. bond market, and this is a recent danger signal. You said you expect volatility, derivative stress, and possibly higher borrowing costs. Did you want to expand on that?
Yes. When the legitimate investors in the bond market pull out, it's because the central bank is the dominant player. I don't have exact figures, but I saw a graphic a couple of weeks ago showing the various components of bond demand. And in the last 3 or 4 years, it's just like an upward spike, gradual rising central bank demand for the U.S. Treasuries. The legitimate buyers are just going away. Now, when that happens, you have a distress signal of the liquidity drying up. The volume each day, it's not like you've got, these 20 groups out here selling and these 19 groups buying and the other way around the next week. So they offset each other, high volume and, good stability and equilibrium and this and that. To begin with, there's no equilibrium when you've got interest rate swap derivatives providing enormous amounts of artificial fabricated demand. Just a quick stat, I like repeating this over and over again. In the second half of 2010, Morgan Stanley injected $8.5 trillion worth of artificial demand through their interest rate swap derivative mechanisms. And that was the time when the U.S. government was losing its pristine AAA debt rating. And the whole world was celebrating, oh, look at that. Even though there are problems, we still have a bond rally. While everybody was pulling out. I mean, this is not complicated if you bring in the interest rate swap derivative factor. So the central banks are driving out the legitimate players. It's kind of like the Gresham's law and a corollary. Bad money will drive out good money. The good money will go into hiding, namely the gold and the silver. And the phony money will come out and dominate the tables. Well, now you've got the same sort of thing going on with the liquidity loss. You've got the good players leaving, so only the bad players are putting their money on the table. It goes from really bad money in the dollar without a gold backing to the central bank fabricated money dominating the table. This is just a screaming alarm signal. The bond market is ruined. The good players they're selling out to the Fed. They're realizing, well, gee, the U.S. government's got these chronic trillion-dollar debts. They got the wars going on endlessly with, the costs that keep on coming. The legitimate bond investors are nowhere. Why should we invest in treasury bonds? So they back out and they realize, well, the Fed's the buyer of last resort, and they don't seem to react to the fact that their balance sheets turn toxic. It's now $4.5 trillion worth of toxic crap. So the legitimate buyers are dumping to the Fed. And at the same time, you've got a lot of other extraneous factors playing that are kind of interesting, like, big commercial trade deals taking place, infrastructure investment, and payments are being made in treasury bonds that get dumped at the Fed's doorstep, so they have to lap that up. Soon the Fed's going to have to lap up what Western nations dump from their banking systems in treasury bonds. What say Korea will dump, what say Singapore, Taiwan will dump. Also, you've got some bond dealers showing some formal stresses. They're obligated under contract. And I haven't seen any news in the last year or so of any new bond dealers backing out of their formal role as primary bond dealers, which means that if there's an auction, well, they serve as intermediary. But now, they're selling as an intermediary to some of the big wigs and the mechanisms running the mechanics running the interest rate swap derivatives. Now, this low liquidity is a weak link that signals very heavy dependence on the interest rate swap derivatives. We haven't had any news in the last 2 years about the London whale. That was a springtime 2012 event where JP Morgan admitted having some interest rate. They had admission of derivative losses, and they lied about it. They said it was related to the currency markets, but no, it was related to the interest rate markets. I cover this very thoroughly. So the stresses are all over the place, and notice that there's entire collusion going on between the financial markets. I mean, between each of them, the currency market, the bond market, the oil market, the central bank balance sheets, the derivatives that the big banks run on behalf of the central banks. They're all connected. And the newest stress is the crude oil price. So the lower crude oil price, I think, has caused incremental damage as banks are on the debt hook. This goes beyond shale, Elijah. It goes way beyond shale. The shale oil projects, those marginal projects that are being called subprime oil bonds. The subprime problems are going to blow up. They've already started in the energy world, and they're going to extend, by the way, into the car market, the car bond, automobile subprimes. And they might even extend to the final piece, which is, kind of a strange piece, but student loans are, just all over the place, subprime. So where are the new jobs for all these indebted new students? They're nowhere. And you can't do a 7-year loan on a car. You can't do that. It's in negative equity when he drives it out of the lot. You can't do these things that the West is doing and get away with it. So it's catching up. You're pointing out the signals. And another real big signal, it's not in our notes, it's not planned here, but I'll just mention it. It's the money velocity. If QE and all the bond purchases were truly stimulus, how come the money velocity is going down and is roughly at 1/2 the velocity of where it was in 2007? It's because QE is killing the economies by killing capital. It's not stimulus. Hyperinflation is never positive. Putting a positive name of stimulus on it doesn't make it good. Just makes it part of the Goebbels propaganda scheme. It destroys capital by eradicating the profit margins, and that's done by the simple reaction. You do hyperinflation by the central banks, and it's not the U.S. alone. It's the British, it's the Europeans, and it's the Japanese. The reaction globally is to hunker down in hard assets, which raises the cost structure and lowers and shrinks down the profitability. So you get closed down businesses. Now, I've been very adamant, Elijah, in the last 2 years that QE is a guarantee. All this bond purchasing through monetized means, not sterilizing it, which means not removing the money from the system as new money comes in. These bond purchases are a guarantee of systemic failure, and we're starting to see more and more signals. And they just ramp up the volume on their lies. What recovery? Housing market's not in recovery. Bond market's being sustained by the Fed. There's no market that's strong and healthy. They're all croaking. It sounds like exaggerating nonsense. It's not. The liquidity loss in the bond market is very serious. What it means is the Fed must soak up whatever new shock comes into the system. Like if a bunch of new bond supply hits the market, the Fed must take it immediately, which means they must lie bigger. They're lying and saying they've ended QE. They've not lied. They've not ended anything. They're relying more on the interest rate swap derivatives for artificial demand. So I think we're going to see a breakdown in the bond market from derivative accidents. It's going to be very interesting and very scary.
Now, I wanted to move our focus to another topic that you wrote about in your article. You said that many big Western banks are being rated near junk status. Did you want to discuss a little bit about how this is related with the banks being insolvent, and also just how this came to be that these big Western banks are now being rated near junk status?
The problem really came to the fore when Lehman Brothers failed, and I don't even want to get into all that. That was a calculated kill job organized by J.P. Morgan and Goldman Sachs. And, just a real brief point. Goldman Sachs was on the edge of failure. So they killed Lehman, took over control of AIG, put it under government supervision, and then made sure Goldman Sachs was given 100 cents on the dollar for all their bonds and derivatives. Gosh, is that not obvious for a financial crime scene? Okay, so after Lehman Brothers event, these big banks were ridiculously insolvent. And that's when they started talking about, there's trouble in credit extension and all these nonsensical excuses. They had to put up a lot of money to cover their bond fraud settlement cases. They realized, well, we can't make money in commercial lending, so let's ramp up, say, the bond carry trade. Yeah, the bond carry trade. So here's your biggest indication that the 0% will never leave. Well, there are two indications. First is they need the free money to make fabricated 10 and 30-year bond demand. It's all artificial. And the second is if you've got this spread between, say, the 10-year and the 3-month, or call it whatever you like, whatever your favorite short term is, short-term bond to short, or treasury bill to short, or just straight old Wall Street lending from the Federal Reserve at near zero. I mean, who can borrow at this 0.25% from the Fed? It's the Wall Street banks. So they borrow the money and feed their machinery for the interest rate derivatives, but they also arbitrage, borrow the money and invest in these treasury bonds. Why do you think the interest rate, the bond yield interest rate for these treasuries is going down, down, down with all these problems? It's because they carry trade. So the Fed is not going to raise interest rates and wreck the interest rate swap derivative machinery. The Fed's not going to raise interest rates and eliminate the profit for the big banks from carry trade. Borrow for next to free and invest in treasury bonds. I'd like to do that. The bankers have been, all over the place in the last 20 years in making money without work. And it's coming to an end. One more big bank crisis, and the dominoes are going to begin to fall. These banks we had an event last month where several British banks and a couple of their subsidiaries sitting in the European continent were downgraded. And they're one level from junk. And this is very important. The next downgrade, you're going to get major London banks as junk. I mean, it bears repeating. One more crisis, one more big loss, like Greece, restructured debt, debt write down, like one major bank, such as Portugal's Banco Santo Espirito, it got rescued at the last minute. They had a death event, and they realized, well, we can't let this happen because it caused some dominoes. So one new bank that dies, one new debt restructure, and Italy and Portugal and Spain are right behind. So any kind of debt restructure that Greece gets, expect it to be amplified by a factor of 10 by Italy, Spain, and Portugal, maybe even France. Little debt forgiveness there. So one more event, and these British banks are going to be falling into debt hell with junk status. Some naive listeners might say, well, so what? Isn't that just a label on a piece of paper? No, it means that all kinds of investors and investment houses and mutual funds can no longer, by their own laws, by their own guidelines and bylaws, they can no longer invest in a junk bond. They must get rid of them. So going to junk has an immediate cascade effect. I thought for a while that Deutsche Bank was going to be a big event for, forcing, like a flick of the finger, bang, there goes a domino, and there go the rest. But Deutsche Bank is, they're hanging on. They're not hanging on with good health. They're hanging on by, I'm afraid, some corrupt influence of their BaFin, BaFin. It's kind of a combination of Securities and Exchange Commission with FBI, if you will. It's a legal and a watchdog agency in Germany, and they just declared that they see nothing wrong in the gold market, no price collusion or anything like that. I mean, God, it's just so utterly, obviously clear. So in other words, Deutsche Bank is not going to be the rogue that topples the big banks, because they're in cahoots with the big banks and have been for a long, long time, with a major event in 1998 when Deutsche Bank acquired, kind of like a discharge from New York. We need a European outpost for Bankers Trust, which was called the Fed's Bank. The Bankers Trust, it was a house for derivatives, all the different bank derivatives, those scummy contracts that I think have no value at all. They just have a function. They don't have any value. Anyway, Deutsche Bank acquired it in 1998. The downgrades, though, Elijah, they were predominantly British banks, and they were big names. They're all very recognized names. They were the biggest of banks. They weren't all downgraded, but they were downgraded, and they're one level from junk. I'd like to point out, we didn't identify this as a topic, but it fits right in here. I got a message. It was kind of an alarming phone call a couple of weeks ago from a very good, reliable source who's in Switzerland. And he said, Jim, you're not going to believe this. The big Swiss banks, even the middle-sized Swiss banks, they're turning down, they're rejecting, they're saying no to legitimate cash bank account owners. They're refusing withdrawals. And I said, well, gee, what's the size of these? And they said, well, the accounts range from anywhere from, a couple $100 million to $4 billion was the largest I heard of. And I said, wow, what is the range of the bank? Well, they're all across the Swiss banking system. I said, well, what's the range of the client nationality? Are these all European and Swiss? And he said, no, they're predominantly European and Swiss, but they're Asian, they're Russian. And I said, well, any other How about Arab? No, no, none are Arab. Arabs have their own licensed banks in Geneva. I said, well, they can't be any Americans in there because they got booted in the last 2 years ever since UBS became a pet project. He said, right, right. They're mostly European and Swiss, but they're quite a few. It's not small for the Asians. And I said, anything else you can tell me about the nature of the accounts? Any dirty money in there? He said, oh yeah, I'm sorry, I left out one. South American. They're South American clients. I said, oh my gosh. So you've got some narco money from the Colombians. You got narco money from maybe European sources. You got narco money even possibly from the Russians. Although I'm quite sure, I've heard this from 2 or 3 different areas, that the Russian money in Switzerland is oligarchs hiding, getting out of Russia for the sanctions problems. They don't want their money frozen inside Russia in Russian banks. When I say Russian oligarchs, I'm really not referring to the Ukrainian situation. There are 30, 40, 50 different Russian oligarchs. They're just the multi-billionaires. So they're moving. They had their money in Switzerland. Now I'm hearing more indications just in the last several days that something very big is going on. That I've been calling this the new sheriff in town from the east. You've got these new forces involved in Asia. I don't like putting names on them because people tend to, oh, look at that name, I'll dismiss that. No, these are very wealthy, important, powerful families in Asia, not entirely China, but mostly China. And they've been throwing their weight around. They're trying to fix the system. They're trying to remove power from the corrupt centers. They've been draining the London gold. I've been mentioning this factor for 2 years. They've drained over 20,000 tons of London gold since the spring months of 2012. We're talking over 2 years now, approaching 3 years. I'm hearing indications just in the last week that this new sheriff in town from the east has been freezing some, how should I call it, black hat accounts in the Swiss banks. By black hat, I mean banker cabal that is not cooperating. By that, I mean narco traffickers that are not part of the, I don't want to call it the reset, but new deals being struck to clean up the system. There are a lot of deals being struck with the banker cabal. And the lack of cooperation is with the elders of the banker cabal because their next generation is almost all signing on. So the new factor that might be at work here, very hard to confirm, in the Swiss banking distress could be frozen accounts of the most vile of the banker cabal players. And recall that in 2006 I had 2 death threats, and one of them was by Swiss bankers. So got no love there for them, and if they're having a lot of distress, I wish them a speedy move into bank failure. There are other indications of big bank distress, and it's negative interest rates. I call it another last gasp. You've got not only the bond markets dependent on central bank money, you've got the banks running out of opportunities to make money in the legitimate traditional commercial lending ways. I mentioned the carry trade of borrowing the free money and investing treasury bonds. That's very important for their profit structure. But now, instead of making money the old-fashioned way in lending to corporations for, say, a strange concept like capital formation. Capital formation, what's that? You borrow money, you invest in some business, you buy some equipment, you buy some patents, you get the business, you make the buildings, you make the mills, you buy the ports, you do whatever. You sign the contracts for transport. It's called capital formation. Western world's forgotten what it is. It's the essence of capitalism. So instead of making money on commercial lending, they're making money on their bank deposits. They're charging their investors half a percent, three quarters of a percent. The list of nations that have gone to some negative interest rates on their cash accounts is growing. It's alarming. This is not good. So what are you going to call that? Economic stimulus? You clown central banks? Elijah, it's just getting bizarre everywhere you look.
This video was brought to you by ReluctantPreppers.com. Click here to listen to Reluctant Prepper's latest interview with Jim Willie, where Jim Willie outlines the seismic shift that has been ongoing for decades away from the US dollar, accelerating in recent years and months across the globe. Willie spells out how the dying dollar threatens the average family and what you can do to prepare and protect yourself.